In July 2010, the Dodd-Frank Wall Street Reform and Consumer Protection Act was signed into law by the Obama administration to address the too-big-to-fail problem and prevent a crisis like 2008 from happening again. It includes corporate governance and executive compensation reforms, new registration requirements for hedge fund and PE advisors, heightened regulation of OTC derivatives and asset-backed securities, and new rules for credit rating agencies. The Act also mandates significant changes to the authority of the Federal Reserve and the SEC, as well as enhanced oversight and regulation of banks and non-bank financial institutions. For example, the Act increases the amount of capital that banks must hold in reserve, giving banks an added cushion to absorb loan losses in future downturns. It similarly requires banks to keep a larger proportion of their assets invested in things that can be easily liquidated in the event of a bank run, like cash and government securities. Every bank with more than $50 billion worth of assets on its balance sheet must submit annual stress tests administered by the Federal Reserve. It determines if they would survive a hypothetically severe crisis like 2008. It reintroduced the Volcker Rule, which outlaws proprietary trading at universal banks, thereby limits their trading operations to serving as market makers for institutional clients. This is to prevent banks from taking on too much risk. Next, Basel III is an international regulatory framework, and its original changes were published in 2010. However, its implementation has been postponed to 2019. It's a comprehensive set of reform measures to strengthen the regulation, supervision, and risk management of the banking sector. The Basel Committee has no legal force but formulates supervisory standards in the expectation that individual national authorities would implement them. The committee now includes 27 jurisdictions. Basel III requires minimum capital ratios, calculated as capital divided by risk-weighted assets. Basel III tightens the definition of both capital and risk-weighted assets and raises the minimum capital ratios required. Capital will now focus more tightly on common equity. Risk weights for capital market activities will be increased. It further strengthened its liquidity framework by developing two minimum standards for funding liquidity: the liquidity coverage ratio and the net stable funding ratio, which measures short-term and long-term liquidity respectively. In Basel III, a minimum leverage ratio requirement of 3% is currently being tested. Leverage is the amount of debt used to finance a firm's assets. It's used as a measure of the resilience of a financial institution. Basel III's leverage ratio is calculated by dividing the capital by the exposure. Lower levels of leverage is an important factor in reducing the overall systematic risks. It also recommended a fundamental review of the trading book, which is a portfolio of financial instruments held by the brokerage or a bank. Those instruments are purchased or sold to facilitate trading for clients. The current system of using internal models to assign risky assets weightings and establish capital levels is too complicated and can be easily manipulated. The new framework addresses weaknesses in risk measurement under the internal model-based and standardized approaches currently used to promote consistency across jurisdictions. The CRD4 package consists of the Capital Requirements Regulation and the Capital Requirements Derivative 4. It's a revision of the original CRD, which was deemed insufficient in light of the 2008 crisis, with the aim of decreasing the likelihood of banks becoming insolvent. It includes enhanced requirements for the quantity and quality of capital, a basis for new liquidity and leverage requirements, new rules for counterparty risk, and new standards including a counter-cyclical capital buffer and capital buffers for systematically important institutions.